Hello, and welcome to the webinar, Unlocking the Future of Small Business Retirement, a deep dive into Secure 2.0. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll turn things over to our speaker. First, we'd like to thank Ubiquity Retirement and Savings for their partnership with today's event. They've been wonderful partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Ubiquity Retirement and Savings. We appreciate you joining us today. We also welcome you to stay socially connected during today's event. For those of you who are active on social media, please use the hashtag ArgyleDigital and follow us at Argyle Exec Forum. Also be sure to follow Argyle on LinkedIn for special announcements. I also wanted to take a minute to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. Finally, and most importantly, we want to hear from you, so please submit all questions that come in during today's event into the chat section of the interface. It's on the right-hand side of your screen. Following the discussion, we've set aside time to weigh in on your questions. Now, without further delay, let's introduce our speaker and begin our discussion. Today, we are joined by Chad Parks, who is founder and CEO at Ubiquity Retirement and Savings. Let's begin with our first question. What is the problem that Secure 2.0 and state mandates are trying to fix?
Hi, Eric. Thank you for having me. I'm very happy to be partnering with you today. And it's a topic that's near and dear to my heart. So hopefully today we can share some very important information with the audience and really let them know what Secure 2.0 is all about and how they can benefit from it. So the problem that the policymakers in Washington and at several state levels are trying to solve for is the fact that we have a looming retirement crisis in our country. There's literally over 5 million businesses that represent almost 60 million employees of those small businesses who, believe it or not, today still don't have access to an ability to save for their retirement through their employer. So that's what we call the looming retirement crisis. 5 million businesses, 60 million people without access to a traditional 401k or other type of retirement savings plan. There's a lot of reasons why. Some of it has to do with cost and or the perception of high cost and or the perception of difficult administration tasks, etc. But really the reality is that the way things are today in the marketplace, there's really no excuse or no reason a small business shouldn't be part of the retirement savings system. And our policymakers are doing everything they can to alert those business owners and their employees to this by incentivizing them and giving them motivation to do so, which is what we're going to talk about today.
Great, thanks, Chad. You've been working on this problem for more than 25 years, and you started as a certified financial planner, and you were also a registered investment advisor before you started the online 401k in 1999, which is now known as Ubiquity Retirement and Savings. You also produced a documentary on the subject. Before we get into questions, can you tell us a little more about that?
Yeah, thank you. So about in 2012, 2013, we've been working at this for quite a while, and we had seen a lot of the challenges that small businesses and their employees faced in putting a retirement plan in place. But also more importantly, we looked at the bigger picture of where are we as a country with the different generations and their approach to their ability to retire with dignity. So what we did is we decided to undertake a project in which it's a documentary, it's a feature-length film, 80 minutes in nature, that looks at 3 different generations, the boomers, the Gen X, and the millennials. And it looks at the promise of retirement, the 3-legged stool of pensions, Social Security, and personal savings. And it really just compares each generation's experience with what they have in terms of their ability to save, their ability to retire, and their ability to see themselves through their older age. So it is a heavy subject, but it is, I think, very well documented. And we'd encourage everybody to take a look. It is available on YouTube. There's a link in the presentation here. You'll be able to go there and take a view. So I just wanted to appreciate the opportunity to talk about that. It was a pet project that was near and dear to our heart. It really was more of a public service announcement to really just to shine light on this important matter and to illustrate with statistics how important these things are. Now, if we fast forward 10 years later after we released the film, 11 years actually now, unfortunately, some things haven't changed. And you'll see that in the film, specifically as it relates to Social Security. Those problems still have not been addressed. But other things have changed, and that's also, for example, with Secure 2.0 and state mandates. So there's some hope as well.
Great, thank you. I encourage everyone to check that out on YouTube there. For our next question, can you first provide a brief introduction to Secure 2.0 and what it means for employers and employees?
Sure. So, Washington loves their acronyms, right? So what does SECURE even stand for? It stands for Setting Every Community Up for Retirement Enhancement. A great acronym. SECURE, it just happens to come out, which, you want to secure retirement. So with that, 2.0 means it's the second version. So back in 2019, they passed Secure 1.0. And what I would describe it as was a general housekeeping bill that really had taken a look at decades of retirement policy and tried to consolidate it into something that would make more sense and make things more actionable for small businesses and anybody who's in the retirement savings system. That was a good first step. I will note that that was a very bipartisan act of legislation, probably one of the most in that time period. I think the bill passed the House with a 416-4 vote, for an example. Okay, so not much opposition. So that set the stage for Secure 2.0. So they took the learnings of 1.0 and said, what can we do better? What do we need to address here? And what else can we put on the table? And so what we'll go through today is some of those things that Secure 2.0 took 1.0 and improved upon, and I'm going to illustrate to you all what those benefits are.
Mm-hmm. Thank you. So how does the Secure 2.0 Act build on the original Secure Act?
So for example, there are some tax incentives that were embedded in Secure 1.0 and even before Secure 1.0. For example, let's talk about a small business offering a retirement plan, specifically a 401k, to their employees. There was a $500 per year tax credit that you could apply for and offset any fees that would be associated with your expenses that relate to that plan. Secure 2.0 took that very, very much further. So what they did was they have now put in place a $5,000 up to $5,000 a year tax credit for the first 3 years for a small business to offset and pay for administrative and fees such as our company would charge to run that small business 401k plan. So that's very significant because basically Secure is designed for businesses with 50 employees or fewer. What the government is saying is we now take this looming retirement crisis so seriously that we want to incentivize you and if not, in fact, pay for you to have a retirement plan and get into the retirement savings system. There's a few other things too that I know are going to be asked here, but I'll go ahead and address them. And that is the other major tax incentive that's inside Secure 2.0 that built off of the original 1.0. And that is what is considered an employer reimbursement for contributions that the employer would make to the plan. Now, I didn't want to jump in to get too technical too quickly, but it's very relevant. I'll just use some real examples. So this employer reimbursement element to Secure 2.0 says that if for every employee that you have that's eligible, and there's some defined eligibility, we will reimburse you up to $3,500 over a 5-year period for you, the business owner, making a contribution into the retirement plan for that employee. That's different than the tax incentives to put the plan in place. And with what I mean by with real numbers there, so if you're a 20-person company and you have $3,500 on the table of reimbursement from the government over that 5-year period, that's really $70,000 that the government is offering to get you and your employees into the system, get them saving, get them addicted to it, and to really prime the pump on what they're hoping is a turn in our savings rates in this country.
Thank you. So who is Secure 2.0 the most beneficial for?
It's absolutely for the small businesses out there who feel like they have been ignored or they can't find a solution to providing a small business retirement plan to themselves and their employees. The employees are the secondary beneficiaries, of course. So in addition to the tax incentives that I've mentioned, the Secure 2.0 addresses things such as long-term part-time employees. It's a mouthful. LTPT is the acronym that we're using. But what does that mean? I think let's use Starbucks as a real example. Starbucks has a lot of part-time employees. And generally speaking, and for anybody who has any experience with benefits and benefits administration, sometimes part-time employees can legally be excluded and are excluded purposely because of the costs associated with allowing them into even health benefits or retirement benefits. So what this one piece of legislation has done to help with the long-term part-time employees is they define what a long-term part-time employee is, and they make sure that that person can be enrolled and is eligible for the retirement plan. So that's one benefit to the employees. The other benefit to the employers is, like we said, motivation and incentive to pay for any administrative costs, an understanding of what is good plan design. We can talk, I know we're going to talk about that a little bit towards the middle of this presentation, but in terms of what is the right type of plan for you and what rules can we establish to help you understand, for example, what auto-enrollment is that good or bad? Why is it going to be required? Some things such new plan types as a PEP, pooled employer plan. I know there's so much jargon and so much nomenclature in our industry, which is hard for the layperson to understand, that we're going to drill into that a little bit more.
Thank you. So what are some of the benefits and enhancements and tax credits involved with this?
So first and foremost, they want you at the table. So when I say that $5,000 a year up for the first 3 years, up to 5,000, it's a formula that says if you have 10 employees, you're going to get $250 per employee to offset administrative and record keeping fees that your 401k plan provider may charge. What I can tell you from our experience with Ubiquity is that if you're a 10-person company, our fees will probably and most likely be less than the $2,500 tax credit. So what I really try to stress to people is that for the first 3 years, this really could be no out-of-pocket cost for you. Now, there is some technicality. You do need to file your tax return. You do need to indicate that you've had these expenses, and then you will get the credit against tax obligations. So those are some of the things for the technical and for your accountant to help you with, but they are there, and it is unrestricted otherwise. The one thing I mentioned a minute ago was auto-enrollment. I want the audience to understand that there is auto-enrollment is something that you probably heard of in other plan types and other benefits. What it really means is that if you're offering a retirement plan, that no longer will it be that you just allow your employees the option to join. They're asking for you to go ahead and take the proactive step of enrolling them automatically, giving them the opportunity to opt out. So that's a big difference. However, now they understand that there may be a little bit of a more administrative tasks associated with that. So the other tax credit is there's an additional $500 per year for the first 3 years, in addition to that $5,000. So now we're talking about $5,500 of tax credits. So that $500 for auto enrollment is not attached to any headcount or any other restrictions on the plan. It simply is because you're going to be having an auto enrollment plan. So statistically, auto enrollment does prove to be very powerful. What we find as large industry averages is that generally speaking, if it's not auto enrolled, a plan would experience 55 to 60% average participation rate. So if you have a 10-person company, 6 or so are participating. But with auto enrollment, that number goes up to 80%. So only about two out of 10 or 20% would opt out. And generally speaking, when people are asked after several years of having been auto-enrolled, and what I would add is auto-escalated, which means that the savings rate increases every year automatically, they're quite satisfied with the fact that their employer did that, and it was a big burden off of their shoulders because they sometimes just didn't know where to start. So I could go further, but let's stay on track with the other questions.
Thank you. So what are some of the in terms of doing this, what are some of the advantages of partnering with a plan provider?
So these plans are governed by several government bodies. One, it's the IRS, Internal Revenue Service, because these are tax incentives that are being offered in tax credits, as well as tax deductibility of your contributions. Let me explain that briefly in case someone is not sure. So if you decide to participate in a 401k and you are agreeing that you're going to set aside $500 or $1,000 a month or whatever it is you can afford to save, and if you do that in a traditional manner, there's immediate tax savings. So you would see on your paycheck stub that you paid less taxes that pay period because you decided to save into your 401k. So that is something that is sometimes overlooked or forgotten. However, that is one of the big drivers of the 401k and those types of tax deferred retirement savings accounts. The other aspects that we need to be thinking about here is, I don't want this just to be about the tax tail wagging the dog, but clearly there's money on the table. But what we're really trying to do is to create incentives and alignment of policy and retirement plan providers like us to ensure that our platforms, our programs, our systems, our plans are user-friendly, approachable, cost-effective, and that we as a provider will take care of all this nomenclature and rules and regulations that you have to look for. The other governing body of law that we work under is the Department of Labor, right? There's a whole other thing because these plans are under something called ERISA, which is the Employee Retirement Income Securities Act of 1974, right? That's a mouthful too. So if I was you, I would say, forget it. This is all too complicated. I'm not going to do anything. But that's why companies like ours are here. We are called a third-party administrator and a record keeper. And that means that we have those systems and those interfaces, and we have that expertise, and we know how to put a plan together. We know how to keep it compliant. We know how to help you make sure that you, the business owner, and your employees are getting the benefits out of it that you want, that are really available to you. Because there's a lot of different ways to design a plan, to really take advantage of the rules as they're written. So that's why, partnering with a good plan provider will go a long way. It'll save you a lot of headache, save you a lot of money, and actually allow you to get on the path to saving for your retirement.
Sure. So what do employers need to keep in mind as they manage their Secure 2.0 mandated auto-enrollment systems, to return to the topic of auto-enrollment?
So auto-enrollment, we see two camps. The larger companies, let's say with hundreds of employees, auto-enrollment works extremely well because they have multiple departments, they may have multiple locations, they might have multiple types of workers in their workforce. And so they just push the button and say, we're auto-enrolling everybody and we're going to get to 80% participation rate. What we find in smaller companies, and again, Secure is really designed for under 50 employees, but let's go even further, because if you look at the distribution curve, the 2 to 20 employee space, there's literally millions. That's where most of the small businesses in our country are. You get from 21 to 50, there's another cohort, but anything north of 50, there's fewer of those businesses. So what we're really trying to do here is solve for the biggest element of the small businesses out there. And so with auto-enrollment, if you're a 20-person company, it acts a little differently, because most likely if you're a 20-person company, you're familiar with everybody. Everybody's familiar with each other. And sometimes word of mouth is enough that they would join the plan. And sometimes word of mouth also works against you, because if they say this auto-enrollment is overreaching, then sometimes we could see it have the opposite effect. So, but the reality is, we go back to those statistics, and it is that the idea that auto-enrollment is doing the right thing for the employee, that's sort of the premise that the business owner needs to be thinking about. Yes, I should mention that beginning in 2025, new plans going forward will have to have auto-enrollment. Right now it is optional, and we do see a lot of our customers adopting auto-enrollment for the reasons I mentioned. But going forward, to comply, it will be required. Don't be fearful of it. What we have found is that it's really an easy flow. So as the plan is put in place, and as the employer gives the plan provider the census information, just like other types of benefits, there's an enrollment period, and those employees will be notified that, congratulations, your employer has now offered you a retirement plan. You are going to be auto-enrolled into this plan. Here's what it means. Here's where it starts. Here's how much of your pay will be taken. It is a function of payroll, and this is where your money will be invested automatically for you if you don't take any other action. So again, a lot of people just let that default because they find it to be very convenient. They always have an opportunity to say, no, I would not like to participate. But again, that's only a 20% opt-out rate. And so administratively, as long as your retirement plan provider has the systems to accommodate this, and also importantly, it is a payroll function. So you'll be wanting to look to make sure that your payroll provider has some sort of integration with the retirement plan provider, and or that you're comfortable with communicating that information to the payroll company, that a certain percentage of your employees will now have deductions taken from their payroll. Generally speaking, it works out well.
Great, thank you. So what are some of the new state retirement mandates, and how can businesses remain compliant? There is also a map that goes with this question. We'll post the internet location of the map into the chat here.
Yeah, no, this is a great question. So, the Secure 1.0 was a good starting point, but we have to look back historically. As I mentioned, this has been a brewing issue for quite some time. And some of the states decided that the federal government wasn't paying enough attention or taking action. And if you look at the reasoning behind this, these states are the first line of defense and the first line of community support. So they're some early legislators, I think California and Oregon were some pioneers in this back in 2011 and 12, said that, if we have an ill-prepared workforce, if we have millions of people within our state who are not saving for their retirement, and they're going to be continuing to age and get older and need services, they're going to turn to the local municipalities and the state level first before they will ask the feds for any assistance. That's just the way the system works. So they were trying to get ahead of this potential problem. And so a lot of states said, well, let's study this problem and let's require businesses in our state to offer some sort, and I'll stress that, some sort of retirement savings program. It doesn't have to be a 401k. It could be a simple, it could be an IRA, it could be a PEP, and we'll talk about some of that here in a second. But the idea behind it is that, much like for all business owners out there who can appreciate this, workers' compensation wasn't always required, but now it is required in 49 states. The only state that is not required in is Texas, but Texas marches to their own drummer, don't they? So you can see that, when government sees a problem and they try to correct the problem by inserting themselves into it. And I know some folks would say that it's overreach, but really, if you think back in the era of the Affordable Care Act, that was something similar too, where the federal government did get involved and said, if you're not offering health plans to your as a benefit to your employees, you really need to. So that's kind of where retirement's going. But the thing I would also say is that the cost and or complexity associated with retirement plans is probably 1/100th of the cost and complexity is with the health plans. So it's not a fair comparison. It's not apples to apples. It's a similar idea, but it's not the same. And that, again, with Secure 2.0, so the feds finally reacted to these states who were taking action and said, okay, the states are on the path. Let's help them. Let's create Secure 2.0. Let's put money on the table to incentivize these business owners to get into the retirement savings system and also to get their employees going too. So they have started to work hand in hand. And I think, this is an arc. This is a 15+ year arc here we're seeing. And that's why I really would encourage anybody who's interested in this to watch the film, because you'll see the stats from 2012 and 13, and it'd be alarming to see what hasn't changed. But again, some things that have changed, like I mentioned, there was no Secure back then, and there were no state mandates back then. So I think we can say that there is positivity, like I said.
Great, thank you. So how can businesses leverage Secure 2.0 updates to benefit from current legislation and to prepare their retirement plans for future changes?
So it's not as complicated as I make it sound. You asked the question about what should you look for in a plan provider, how can they help you? So companies like ours are very well equipped to navigate all this with you. There are questions that we ask, to make sure that we are designing a plan that would be the best for you and your employees. We look at the demographics. We look at the age of the owners. We look at the age of the employees. We look at the compensation, and can people, quote unquote, afford to save? Because that's always one of the big arguments, especially in today's world with inflation the way it is and everything. Most people default to, well, people can't afford to save. So we really try to design a plan that meets the needs of everybody. And we take advantage of those rules that the government's put in place. And we listen to them and come up with something that will be the best it can be in the time that we're operating in. And as we say, as you asked, future-proof it. Our finger is always on the pulse of legislative change. In fact, I myself am a big advocate. I'm involved in our industry trade group and our association, and have been counseled by, or I am counseling to some of these policymakers in terms of, what's working, what's not working, what else do we need to see here? So, there's a lot of focus on this issue, and we don't expect the average business owner to be the expert, nor should they. And in fact, you mentioned earlier that, I was a certified financial planner. I appreciate you bringing that up. That's really what led me to start the company and to learn more about this area, because I would sit down with small business owners and ask them what their needs were, help them make their own financial plan. And always this glaring hole of there was no retirement plan. And so that's what drew me into this and to become the expert in the space. So it is, it's one of those things that I felt it was a shame that I had to go to grad school to learn the basics of personal finance. And I still think today that small business owners shouldn't have to be experts in this field. And so, companies like mine and others are out here to help with that.
Great, thank you. So returning to another previous topic, what are pooled employer plans and how do they work? So
great question, great jargon, great acronyms. Pooled employer plan sounds like a country club, but it's not. It's also known as a PEP. If anybody has any experience with retirement plans, you might have heard them referred to previously, prior to Secure, as a MEP, which would be a multiple employer plan. A myriad of laws that are stringed together that either make this work or don't work. What Secure 2.0 did was to clean up some of that and to rebrand them as pooled employer plans with a new set of rules that made it a lot easier and more attractive. But what does that mean? So I have a metaphor that I like to use, and so bear with me, please, everyone. But what we're talking about is, like, let's say you go to the doctor and the doctor says, you need to go to the gym, and you finally agree, you say, yes, that is correct. I do need to go to the gym and I need to get healthy. It's very similar to like you working with a financial advisor or your accountant, and they're saying, just like I used to, you need a retirement plan, right? So in the gym example, you're not going to go and lease a space at a strip mall. You're not going to go and buy gym equipment. You're not going to, turn on the electricity and and set up a smoothie bar in your own gym. What you're going to do is you're going to join a gym because somebody else has already done all that hard work for you, and you just simply join and pay your monthly membership. So that's the metaphor I'm using here for what a pooled employer plan is. A pooled employer plan is a plan that has already been set up. It's already got decisions made on your behalf that will fit, 8 or 9 out of 10 scenarios. It is pre-packaged. It is ready to go. The investments are professionally managed, and you can simply join that plan. You don't have to establish a plan of your own. You don't have to worry about making hard decisions. So as you can see, ease and simplicity are something that has been hard to accomplish in the retirement savings space, but with the pooled employer plans, we hope to see that really change that. So when you are out there thinking about what type of plan is best for you, there are a handful of different type of plan types, but it really is going to depend on your personal situation and what you're trying to accomplish. But do remember that a pooled employer plan is a very viable option. You will get economies of scale, you will get cost savings, you will get complete administration and fiduciary investment advice, all taken care of as part of that package, so that you really can just go about running your business instead of worrying about your retirement plan.
Good. So what are some other things that employers need to know about or consider in this context?
Well, it is an area that could keep people away from. I'm listening to myself talk about this, right? I've done this for 25 years, and sometimes I even get a little confused on what options are available. That being said, I think that it's really, you have to start with the why. Ask yourself, why is this important? Why do I need to pay attention to this? It's statistically not only 5 million businesses, 60 million people, but to reference the film again, life happens, and if you don't have a safety net, if you don't have a retirement savings account, if you're not on that path to having some financial security in the future, then it's going to be very difficult for you personally. And we don't want individuals to reach that time of their life where they are looking back and regretting the decisions they didn't make. So that's really has been my reason for being. I've been trying to raise awareness on this issue for decades. I've created platforms and solutions to help address the problem. I've helped to advocate for this cause at the federal and state levels. And so now, it comes full circle to we've done everything we can, and the government has given us basically everything we asked for. Now it's up to the business owner and their advisors and their employees to say, yes, this is the time. We can do this. We will put ourselves on that path. It's not as difficult as we thought. And frankly, what we see is that once people get started, they're glad they did. And eventually they will accumulate enough assets that even if it's a modest amount over their lifetime, it's better than nothing, because we cannot rely on Social Security as the primary source of our retirement income. The average benefit of Social Security is only like $1,400 or $1,500 today. And if you do watch the film or if you read the news, you'll see that Social Security will run out of a surplus estimated in 10 years' time, 2033, 2034. I said the same thing 10 years ago in the film, but then it was 20 years' time. So nothing has changed. Social Security is not going to be there for us as a primary source of income in retirement. If the trust fund does run out of the surplus, then what will have to happen is that it will have a reduction in benefits by about 25%. So that $1,400 or $1,500 check will go down to about $1,000 or $1,100 per month, per person, period. In today's world, that's a very difficult reality. Pension plans, some folks have experience with their parents or their grandparents or even themselves if they're lucky enough to be in a pension plan. Pension plans have been contracting over the last few decades. Companies, when they can get out of being in the pension business, will. Any new hires that go into a business today, generally speaking, probably don't have a pension plan offered to them unless it's government or unionized. And so that idea of that pension plan being there as a supplement to your income in your retirement years, for most people is not a reality. So that just puts the onus right back on us as individuals. Personal savings is key. There are tools and vehicles and incentives to take advantage of this, and we've laid everything out, and that's where we are. So, as a financial planner in the past, I did take it very personally that our clients, my clients, would listen to the advice I was giving them and get things squared away. So it's hard for folks to think about the future when everything is so important day to day. But we have countless stories and countless others where, like I said, even a modest amount of savings is enough to bridge the gap and to give people a dignified retirement. So if nothing else strikes the chord, hopefully, to think about that, both for yourself and your employees, is what we're really trying to stress here.
So speaking of employees, let's discuss their needs and their point of view in a little more detail. What employee needs does Secure 2.0 address?
So several, the auto-enrollment feature that makes it easier for them to get in and get going without having to overthink it. We mentioned the short-term part or the long-term part-time folks, who generally been excluded. In the instance of a PEP, pooled employer plan, in most cases with other retirement plans, the investment choices that are available have been curated by a fiduciary investment advisor. And in most cases, they can default into either a target date fund, or there's a default investment that would be appropriate for their age or risk profile. So the reason I mention that is because one of the other things I think from an employee standpoint is that most do not consider themselves investment experts. Most people in general don't consider themselves an investment expert. I don't consider myself an investment expert, and I am in the business and I've had all the licenses, so it is one of those things that we should not expect the average employee to have the confidence and wherewithal to be making these important decisions. So rules have changed not only with Secure 2.0, but over the years, so that now it is feasible and it is practical for third-party professionals to give them the opportunity to be able to let these employees save without having to overthink it. I will separate the two. Savings and investment are two different things. And one thing I think that is worth mentioning too is that if somebody is risk averse or somebody doesn't want to invest in the stock market through their 401k, it is still a savings account. You're still putting money away. You are still saving on taxes today. And if you become more comfortable and you want to invest and see the money grow, even if you invest it conservatively, that's always an option. So these are some important things I think that employees need to be exposed to, because I think there's a lot of misinformation and or misperception out there about what these are and are not. And again, through these legislative changes and through interfaces and you working with companies like ours and having professionals and really guiding people through the process, it's a different era of retirement plans today than we've seen before. And I think employees are the ones who are going to benefit from that.
Great, thank you. So what are the implications, moving to another topic that we've already covered, long-term part-time employees. What are the implications of Secure 2.0 for long-term part-time employees?
Mm-hmm. There's a lot of complicated mathematic calculations that have to go on in order to determine when you are considered a long-term part-time employee. However, the rule of thumb is very simple. Let's say that you've worked part-time for a number of years, and maybe you took a break, maybe you came back, but at some point you are deemed eligible to now be part of the retirement plan from your employer. And this isn't just small businesses. This is large businesses too. So that's why I used the Starbucks example earlier. I have a personal story. When I first moved out to San Francisco, when I was going to grad school, one of my jobs was to work for Bank of America as a teller. And Bank of America wouldn't let me work more than 19 hours a week because they did not want me to trigger eligibility for any of their benefits packages. So literally at hour 18 and a half, my manager would be over there and saying, you got to clock out, you got to go, right? And so as a part-time person, that was less than ideal for me not to be able to receive benefits. And I also worked a second job where I was, filling the other 20 hours a week, but that wouldn't qualify me for benefits either. And so in today's reality, there's a lot of people who want to work part-time or they like to work multiple jobs, and they should have the safety net and the benefits of these packages that are being offered. And so I think that's really what Secure 2.0 tried to address, which is facing the reality of today's workforce and their needs, and not necessarily eliminating them and considering them a burden to the employer, rather than saying give them the same benefits that a full-time would have. So that's really great to see. And I think your next question is going to be similar to that on the gig workers. So
that's right. And the next question is, what are the implications of Secure 2.0 for gig workers and for their employers as well?
Yeah, so very similar, right? So if you are a part-time employee, they've taken the steps of giving you more access. One of the big trends we see too, though, is that sometimes part-time employees are no longer W-2 employees. They've been forced to become a gig employee or a 1099 employee, which means they're out there on their own working their gigs. And that spectrum of gig, it's not a bad thing, but the spectrum is quite large, right? So many people could be considered self-employed that, in fact, when we talk about those statistics of 5 million businesses and 60 million employees, that's literally businesses and employees. Some data would show that there's upwards of 25 million or more self-employed individuals out there making it day to day. So the retirement savings system and other health benefits, et cetera, have long had to figure out how to deal with these self-employed people. And now, it's not necessarily a derivative of Secure 2.0, but the way in which self-employed people can participate in the retirement savings system is that there are full-fledged retirement savings plans, and some of them are 401ks that are designed for that self-employed person. Let's use a real estate agent as an example. A real estate agent, is probably making a reasonable income. However, being self-employed as a 1099 of that agency, they're responsible for all of their taxes, including their self-employment tax, which doubles their Social Security and Medicare tax. So right off the bat, a self-employed person, so all business owners know this, we pay half of the Social Security and half of the Medicare tax. The employee pays the other half through their paycheck. So when you look at your paycheck and you see FUTA, FICA, SSN, all that stuff, that's your half. If you are self-employed, you're paying both halves, your employer and employee. So that equals 15.3% just to employment taxes. That's not even income tax. So you're already behind the 8 ball as a self-employed person. So what can you do to take advantage of tax savings through a retirement plan? So there's these products that are called, we branded ours Single K. Others might call them Individual K or Solo K. But for all those out there who are self-employed or know self-employed people or advise self-employed people, do realize that you can have a full-fledged 401k plan that will give you the actual savings limits that a regular employee would have. And round numbers, it's $21,000, $22,000, $23,000 a year salary deferral for the 100% of that salary deferral up to that dollar amount. And then there's also a component of what's called profit sharing. So I won't go into all the details other than to say that as a self-employed person, you do have a great tax shelter available to you in a 401k plan that can save you, $15,000 to $20,000 a year of income taxes if structured properly. So we really don't want to ignore that group, and we want to make sure that they understand what the advantages are to them. Now, there's the other end of the spectrum, which is the groups who are not earning as high potential. And so, there are programs like auto IRAs, payroll deduct IRAs. There's just regular IRAs, individual retirement accounts that they can fund, and is, a little is better than nothing. So, as gig workers or self-employed people, just please realize that there are a lot of options out there for you.
Great, thank you. The next question is, what are some good ways of keeping updated on legislative and regulatory changes?
Well, C-SPAN. No, I'm kidding, of course. I think that it's a good question. Clearly, running a small business or, being involved in a small business, you have a lot of things you need to keep up on, be it your local municipality, your business licenses, your registrations, your tax code at your local level. It gets complicated. I myself, it's hard for me to keep up sometimes with every month. There's this notice that this thing is due, or this month they're wanting me to submit this form, and it's like, wow, it's very overwhelming. So this is where your trusted advisors can come in. I know it's hard to do everything, to wear all the hats and to keep all the plates spinning. So, either it's an accountant, a bookkeeper, a CPA, a company like ours, your payroll company to a certain degree, other consultants you might work with. That's where your best bet is to turn. But you really need to find people who focus on this and who are experts in the field to be sure that you are getting everything that you can out of what is put forth on your behalf.
Great. Thank you for that excellent discussion. Just as a reminder to the audience, you're still welcome to enter questions in the chat section of the interface. Just enter your question there and we will pose it to our speaker today. I'm just going to start going through some of the questions that we've already gotten. The first of which is, how do I know if I qualify for the tax credits that you mentioned?
That's a good point. So I know that when you hear tax credits, sometimes you can think that these are too good to be true, right? And there was a recent wave of the ERC, the Employee Retention Credit, that was going around, to follow on from the pandemic. So what I want to stress here is how to know if you're eligible. Basically, any business under 50 employees is eligible for these tax credits. The real issue is whether or not you have taxable income that you can receive the credit from. So in some cases, small businesses might be running at a loss and they're thinking that they won't get the benefit of the tax credit. However, again, working with an accountant or your CPA or bookkeeper, you'll know that you can carry this credit forward, which means that you will accumulate so that when you do have a taxable event or a taxable year, you can use these in the future to offset those. So it's not for nothing. So definitely pay attention to that. And clearly, if you are in a profitable situation, then that tax credit will reduce your tax liability. I just want to stress again, though, that other employer contribution credit that I mentioned, that is separate from your income of your business. That is a dollar for dollar reimbursement of your contributions on behalf of your employees year after year for the first 5 years together. Does that make sense?
What's a 401k compared to a simple? And that's all in capitals, and I assume that's an acronym. Do these credits and mandates apply?
Okay, simple. Yeah. So SIMPLE, all capital letters. That is an acronym as well. Don't ask me to say what it is. It's something. I would often say that simple is an acronym. It is not an adjective. Okay, because a simple plan is a type of retirement savings plan, very similar to a 401k, has a little bit of different rules, a little bit of different contribution limits, a little bit of different eligibility requirements, and most importantly, a little bit different matching requirement. So what happens is one of the things that we find that small business owners have a misperception of is that they say, I don't want to do a 401k because I can't commit or I can't afford to do a match, and I know I have to do a match. So the good news about a 401k is no, you do not have to do a match. That can be in your plan design. You can just say, we're not going to do it. And if we have a good year, we'll do it as a profit sharing, but I'm not going to sign up for a permanent match. Now, it is a great incentive. Employees do benefit from it. It does help with recruitment and retainment of employees. That's all something that needs to be looked at, but you don't have to do it if you don't want to. Now, with a simple, you actually do have to do it after a certain period of eligibility. So I just want to caution people that a simple is, again, that acronym, not an adjective. It may be a good option for you in certain cases. However, I don't want to use more jargon, but I have to. If you are considering a simple, then you should also seriously consider what is called a safe harbor 401k plan, which gives you more bang for your buck. If you're willing and able to do that match, a safe harbor plan will get you further faster. And so that's how a 401k compares to a simple. And then in terms of how does simple fall under Secure 2.0, to the best of my knowledge, those plans are not eligible for the tax credits. I'm going to caveat that. I have to research that. I don't want to go on the record, but check with your accounting professional. But I do know that as it relates to the state mandates, a simple can meet the mandate. So in other words, when I said earlier that these states with mandates saying some kind of retirement plan, that can include an IRA, a simple, a 401k, or other type. So just keep that in mind.
Thank you. This next question is a good one. Do I have to be profitable to claim the credits?
Yeah, so thank you. Yeah, so I think I addressed that a little bit. You don't have to be profitable to claim the credit in the year in which you're claiming the credit. It does roll forward so that when you do become profitable again, it will offset that.
And the next question is, are there any catches? This seems too good to be true.
Well, I mean, clearly there's a lot of conditions that you need to be aware of. You know, like we said, there's a formulaic approach to the tax credit. When I generically say up to $5,000, I did mention briefly that is calculated at $250 per eligible employee. Now, what is defining an eligible employee? An eligible employee is an employee who is not an owner or a highly compensated employee. What's highly compensated? That's defined by the regulation. So if you're a 20-person company and you've got 2 owners, just think about it that most likely 18 out of the 20 will be eligible for that $250 credit. All right, that's the best way to think about it. Now, if you're a 40-person company and you're trying to do that math, it caps at $5,000, right? So you still get the $5,000, but you can't necessarily apply it at $40 per 250. So there's little things like that, subtle nuances that we help everybody go through to really understand, one, how to maximize and or optimize, I think is a better word, these tax credits that are available to you. So I won't say that there's catches, but there are nuances that need to be thought of. But the reality is that you most likely will benefit from this one way or the other. To what degree? Work with a company to help you determine that.
Great. Thank you for that insightful session. That was really informative. This concludes today's webinar, and I'd like to thank everyone for joining us today, and thank you again to our partner, Ubiquity Retirement and Savings. I just wanted to remind everyone that there is an ebook in the handout section of the interface, which is on the right-hand side. And also, we reposted the location for the documentary, the Broken Eggs documentary, in the chat. So I encourage everyone to check those two resources out. This webinar will be available on demand for the following week. And once again, please check out the resources in the handout section. And if you'd like to learn more about Argyle, please join us for a short video. Thank you again, and enjoy the rest of your day.